Good day, everyone. I hope that wherever you are, you're staying safe and that able to patiently wait for our turn for our vaccination. I know I can't wait, but anyways. So each will get our opportunity, I hope. Okay? So what are we covering today? Well, today we're continuing to talk about money. Last time we talked about the central bank in certain ways, but now we're going to talk about monetary policy. The central bank's policy towards the money supply and what they can do with monetary policy to impact the economy. So the power of monetary policy in the short run and the lack of power of monetary policy in the longer term. So as an outline of where we're going, well, to talk about monetary policy, we have to talk about more than just money supply. We also have to talk about money demand. So we'll talk about the money demand curve and the factors that influence money demand. So why it has the slope that it has and why it shifts. So what we're going to talk about is something called the theory of liquidity preference. That's our framework or our model that we'll use to talk about the market for money. So the theory of liquidity preference is a theory that describes the market for money in equilibrium, money supply intersecting money demand. And we're going to use this framework, this model, we're going to use it to determine the equilibrium interest rate. And so let's pause for a moment, sort of step back and look further at the bigger picture. We know in the income expenditure model that the planned expenditure line, when it crosses the 45-degree line, we get to equilibrium, where income equals expenditure. And we know that the location of the planned expenditure line depends upon the interest rate. And now we're saying that the central bank controls the money supply, and they can manipulate the money supply to shift the money supply curve and alter the interest rate in equilibrium, which means then that the central bank can shift the planned expenditure line upwards or downwards depending on whether they're lowering or raising the interest rate. And so again, monetary policy, the use of the money supply by the central bank, we can use the money supply to manipulate the interest rate in this framework where money supply intersects money demand in the market for money. And by manipulating the equilibrium interest rate, we can shift the planned expenditure line, moving to short-run equilibrium of the economy. We also know that whenever we shift the planned expenditure line, holding everything else constant, we're shifting the aggregate demand curve. And so in the aggregate supply, aggregate demand model, we can also check out the impact then of monetary policy. So again, the central bank can manipulate the money supply, alter the supply money, shifting the supply curve of money in the market for money in the framework known as the theory of liquidity preference, influencing the equilibrium interest rate, and thereby shifting the planned expenditure line, and in turn shifting the aggregate demand curve. So these models are all interconnected. They interconnect or overlap with each other. The learning from one model helps reinforce or helps us to further understand the other models. We're also going to take a look at what's called the monetary policy transmission mechanism. How monetary policy spreads out there into the economy, how it transmits. Of course, I don't mean to make anybody feel uncomfortable, but it's like talking about a disease like COVID, how COVID spreads, how it transmits from one person to the next. Does it spread by Jack coughing on his hand and then touching a door handle, and then someone come along and grab the door handle themselves, and then later rubbing their eye or their mouth or something like that? That's a possible transmission mechanism or vector. Or does it transmit because Jack coughed near you without a mask on and you didn't have a mask on? There's different ways that you can transmit the virus that is COVID. Similarly, or perhaps less squeamish topic, monetary policy is transmitted out there through the economy through a number of different vectors or channels. And we're going to talk about those channels and how they each work. Okay? But the big picture, once we take all this, we're going to incorporate monetary policy into the income expenditure model and the aggregate supply, aggregate demand model. Alrighty, so let's get to it. Let's zoom in a little bit more. All right. So we're going to start by talking about the demand side in the market for money. Okay? So the demand for money. And it's tempting to say, and people joke about this, what do you mean demand for money? I want all the money in the world. Money demand doesn't mean, gee whiz, I hope I win the lottery. Money demand is the amount of money that households and firms want to hold on to. How much of their assets they park in the form of money. Okay? So the demand for money comes from households and firms who want to hold money to facilitate their daily transactions, to pay their workers, to buy the goods and services and raw materials that they need, and to pay for the rent and utilities and whatever to keep their home operating or their business operations working. They also might be using the money as a store of wealth, because money is a store of value. And so they might temporarily park some of their assets in money because money is a way to store wealth instead of gold or real estate or whatever. And so we're going to take a look at the various factors that influence why you demand money. And really what we need to talk about, for anyone who's taken microeconomics, you've heard this phrase, opportunity cost. We're going to talk about the opportunity cost of holding money. If I hold money, then I am not holding something else. If I take 40% of my wealth and hold it in the form of money, then I've locked up a big chunk of my wealth in monetary assets. And that means I'm not holding Tesla shares. I'm not holding lottery tickets. I'm not holding that 40% of my wealth in real estate or gold or Bitcoin or whatever. And so the opportunity cost of money is that when you're holding money, that means you're not holding something else. You've given up whatever the other asset might have given you. In the case of gold or Bitcoin, maybe that asset appreciates in value. Tesla shares might do the same. If you own a bond, the bond will pay you interest. And so the opportunity cost of holding money, we store our wealth in various assets, monetary assets, such as cash and bank deposits, and we have interest-bearing non-monetary assets, such as bonds, stock, gold, whatever. Some of those non-monetary assets pay interest. Bonds pay interest. Some stocks pay dividends, which is sort of like an interest rate. Okay? But some stock don't pay dividends whatsoever, and so you're holding the stock hoping for price appreciation, for a capital gain. And so we can hold our wealth in different kinds of assets. To simplify it dramatically, we're going to pretend there's two kinds of assets. Monetary assets, right? Cash and bank deposits. So that's like M1. All the cash out there in circulation and all the demand deposits at chartered banks. Monetary assets. And non-monetary assets. Every other asset that does not qualify as money. Okay? So we have a choice then. Hold monetary or non-monetary assets. And that means there's a trade-off. Monetary assets give you convenience. Non-monetary assets give you the possibility of getting a capital gain or a rate of interest. So repeating that, monetary assets offer convenience. They can be converted into cash very easily if they're not cash to begin with. And that means monetary assets are the most liquid asset there is. They're easiest to use, to spend, to buy something, to acquire a company, or buy lunch, or pay your bills, or whatever. So monetary assets are very convenient because they are the most liquid asset out there in the economy. But they offer very little rate of interest or return. Cash pays no interest whatsoever. And bank accounts that are almost perfectly substitutable for cash also pay an interest rate of essentially zero. I believe I've mentioned this in the past, but I have a debit card account at a chartered bank here in Canada. And the interest rate on that account is 3% of 1%. I repeat, 3% of 1%. That's the number 3% times the number 1%. That means that's a very small number. It's essentially no interest. It's just lawyer speak for we're paying you next to nothing. And if my balance is above $5,000 in the account, then the interest rate rises to, wait for it, 5% of 1%. Again, basically zero. So monetary assets, cash pays no interest whatsoever. A $20 bill always says $20 on the front. And bank deposits that are highly substitutable for cash pay little or no interest also. So again, monetary assets, very liquid, very convenient, but give you no interest or no capital gain. The only way you can have money appreciate is if the general price level were to fall, if there was a deflation. If you have a $20 bill and the price of a bottle of water is $1 a bottle, then a $20 bill will buy you 20 bottles of water. Hooray! And if a year later you still have that $20 bill, but the price of a bottle of water has dropped to 90 cents, now that $20 bill will buy more than 20 bottles of water. Because you can buy 20 bottles of water and get $2 change. And that means you can spend that $2 to buy a chocolate bar or something else. Right? Or maybe a 21st bottle of water or a 22nd bottle of water. So when there's deflation, that means that money is becoming more valuable in real purchasing power terms. If there's inflation, it's becoming less valuable. So money is not a perfect store of value in real terms. It depends upon the inflation rate. If there's a positive inflation rate, the real value of money, the real purchasing power of money is declining over time. If there's a negative inflation rate, a deflation, then the real value or real purchasing power of money is rising over time. It's only when there's an inflation rate of 0 that the real purchasing power of money is staying constant. Okay? So money is very liquid, very convenient, but offers little or no return, at least in nominal terms, and possibly even in real terms, depending upon the inflation rate. Non-monetary assets offer returns to holders. Bonds pay interest. Stock might pay dividends or other capital gains. So non-monetary assets give you returns. I can live in my home. It's a portion of my portfolio. Wealth is my house. And I can live in that house. And it gives me valuable consumption services. If it rains tonight, I have a roof over my head and I can close the door and windows and stay dry. And the raccoons don't, crawl into my house and bother me at night because they're outside instead of inside. And so non-monetary assets give return to us in the form of interest streams off of interest-bearing assets, capital gains off of things like gold or Bitcoin or stock, right? And other forms of returns in terms of the use of the asset in the case of things like real estate or homes or jewelry even, right? So these non-monetary assets are giving us returns that money doesn't, but they don't have the convenience. They're illiquid. It takes time to convert stock into something, so that I can buy dinner with it. I can't use stock in Tesla to buy my dinner tonight. It'd be very rare if I could. Okay? So non-monetary assets offer a greater rate of return than monetary assets do, but you've given up liquidity. This is that trade-off. What do you want? More convenience, more liquidity, or a greater rate of return or interest? So the demand for money, to some extent, comes from this trade-off. Comes from this choice of holding our wealth in the form of monetary and non-monetary assets. Holding everything else frozen, an increase in the interest rate raises the opportunity cost of holding money. Imagine, make it, again, really, really simple. There's only these two kinds of assets, money and non-monetary assets that pay interest, to keep it really simple. Well, then when the interest rate goes up, the opportunity cost of holding money has gone up because you are foregoing more by holding the money. A $20 bill is always a $20 bill. But if a bond pays you a 3% interest rate, you're getting 3% rate of return. And if suddenly the interest rate rises to 5%, well, by holding that $20 bill, I used to be giving up 3% rate of return. Now I'm giving up 5%. Oh my. So an increase in the interest rate raises the opportunity cost of holding money, which means that households and firms, these are the agents that hold money, households and firms would therefore like to hold more interest-bearing assets following this increase of interest rates. And so they say, well, let's shift some of my assets. I want more interest-bearing assets thanks to the bigger interest rate. And that means I'm going to hold more of these assets and less money. So we're going to now hold fewer monetary assets thanks to that increase of the interest rate. And that, of course, means that the demand for money drops. Looking at that in the form of a curve, what we're then doing is relating the nominal quantity money demanded, M for money, D for demand. So MD doesn't mean doctor, not medical doctor, but here money demand. So nominal money demand, the quantity, and nominal interest rate. And what we're saying is that this money demand curve is showing the relationship between the nominal interest rate and the amount of money that is demanded. When the interest rate is nice and low, we demand a lot of money. But when the interest rate rises from this level up to that level, the amount of money we demand declines. Because money doesn't pay interest. And we are foregoing more interest when we hold money. The opportunity cost is that foregone interest. So the money demand curve shows the relationship between the quantity money demanded and the interest rate. Nominal, nominal. This is all nominal. Okay, and as we already acknowledged, the interest rate is that opportunity cost. So we have that inverse relationship, a downward sloping curve. Okay? The rise of the interest rate, number one, has caused the decline in quantity demanded, moving from one point to another point along the demand for money curve. Okay? All right. Let me go back to the previous page. We often say statements like this, holding everything else constant. And that's what we're saying here. Holding everything else that matters from money demand constant, but only changing the interest rate. A bigger interest rate means a lower quantity of money demanded. Well, what are these other things we're holding constant, you might ask? We're holding constant everything else that matters from money demand besides this. These other factors that aren't on the axes but do influence money demand will influence the location of the curve. That's why we're holding them frozen. Because if one of these other factors were to change, the whole curve shifts. Maybe shifts to the right or to the left. So let's talk about the shift factors. So these are factors that influence money demand other than the interest rate. These are the things not on the axes. And they will shift the money demand curve. And so we have a long list of factors. We talk about the direction the curve shifts, and we talk about the reason. Let's talk about these one at a time in turn. So number one, the aggregate price level matters. The GDP deflator, or the consumer price index, the measure of the average price level matters. If the price level were to rise, that means that it now costs more to buy a unit of GDP. It costs more to buy that reference basket in the consumer price index. So an increase in the average price level will shift the money demand curve to the right. The whole money demand curve shifts to the right. At any interest rate, we now demand more money. And the explanation goes as follows. If the price level has gone up, we need to hold more money to pay for the same goods and services. To buy the same consumption pattern, we need more money because prices on average are now higher. To operate our firms, we need more money to pay our workers or buy the raw materials. So we need to hold more money to buy the same amount of goods and services. There's an increase in money demand. So that's one shift factor. Another one is real GDP. If real GDP goes up, money demand goes up, and the whole curve shifts to the right. And the chain of events is very simple. When real GDP rises, that's the real income of the entire economy. So that's an increase of the aggregate real income. And that makes aggregate real consumption rise, thanks to our assumption that in the consumption function, consumption depends positively on disposable income, that after-tax and transfer income. But when real income rises, real disposable income rises, and that makes consumption rise thanks to the positive marginal propensity to consume. And so now we need to hold more money to facilitate this larger volume of consumption transactions. Money demand is higher. Another example, maybe we have an improvement in banking technology. For example, maybe we introduce credit cards, and that will shift the curve to the left. That will result in a decrease in money demand. Why? Well, a credit card allows people to buy things online or in person and not have to use cash or have to use demand deposits because they're using a line of credit extended to them from the bank. That line of credit is not part of the money supply. And so again, the availability of new forms of credit shift the money demand curve to the left. There's a decrease in money demand at any interest rate because people can now make purchases without holding monetary assets or as many monetary assets. Another possibility is we could have a change in other institutional things, such as the introduction of savings accounts that you can write a check on or use your debit card from. Well, that will make a rightward shift. This lowers the opportunity cost of holding money because you're making assets that now pay an interest rate higher than the crummy interest rate my debit account pays usable as a means of payment. We're converting some savings accounts, which were a form of non-monetary asset, into a monetary asset by saying you can write a check on this account. You can use your debit card on this account. And so again, it lowers the opportunity cost of holding money, and that's an increase in money demand, right? Because this kind of account, as it mentions down here, this new kind of account provides convenience to depositors, right? You get that liquidity because you can use a debit card or write checks, but you didn't have to give up the interest. Okay. So we're going to talk about that so-called theory of liquidity preference and show how money demand and money supply determine the interest rate in equilibrium. So again, we're going to use this framework, the theory of liquidity preference, to show the determination of the nominal interest rate, the little I. Like any model, we have a bunch of assumptions here. So let's talk about those. We keep the model nice and simple, which means our assumptions are very generous or very bold. So to get our equilibrium interest rate, to get this model, here comes our assumptions. Number one, there's only one interest rate out there in the economy. There's one interest rate paid on non-monetary financial assets. In reality, we know there's many interest rates. Treasury bills pay an interest rate that differs from 5-year government bonds, which pay an interest rate that differs from a 10-year government bond, or a 20-year government bond, or a 30-year government bond. And then you move over to corporate bonds, and you get totally different interest rates as well. In reality, there's all kinds of different interest rates out there in the economy. They depend upon the term to maturity, whether the term to maturity is short or long. They depend upon whom the borrower is and their credit worthiness. But we just pretend there's only one interest rate to keep life easy for ourselves. Again, we're building a simple model. So number two, the nominal money demand, as we already acknowledged, comes from households and firms, not the government, to keep it simple. Number three, the level of the nominal money supply is picked by the central bank. In Canada, that's the Bank of Canada. So the Bank of Canada determines the money supply. So let's back up to number two. The nominal money demand comes from households and firms. That gives us our money demand expression. And just like we had on our previous slide, the money demand curve shows an inverse relationship between the nominal interest rate I and the quantity of money demanded. The bigger the interest rate, the lower the amount of money demanded, downward sloping. So that's point number two. Point number three, the money supply, MS for money supply, is an amount on this quantity of money axis. It's the amount of money picked by the central bank. So the central bank says, do I want to have that much money more money, less money, how much money do we want? And we're pretending the central bank gets to pick the size of the money supply. That's what that says. Number 4, the Bank of Canada can change the money supply using its regular tools. Remember, we don't use reserve requirements, so I'm not writing those down on the screen, even though I just said them out loud. Some countries do use reserve requirements. So the Bank of Canada can change the money supply by doing open market operations. They can go out into the open bond market for federal government treasury bills and treasury bonds and buy or sell treasury bills and treasury bonds. If I'm the central bank, when I buy treasury bills, I buy a bond or a treasury bill from you, I hand you money. And so when the central bank buys bonds and treasury bills, the money supply is rising. And when the central bank sells treasury bills and treasury bonds, I sell you a treasury bill, you have to pay me money, and I'm taking money out of circulation. So again, when the central bank is buying treasury bills and treasury bonds, an open market purchase makes the money supply rise. An open market sale of treasury bills and treasury bonds makes the money supply decline. We can also change the bank rate. That's another one of our monetary policy tools. Remember, the bank rate is related to the overnight market. And number 3, we can do government deposit switching. We can move government deposits from the Bank of Canada over to private banks or vice versa, thereby manipulating the money supply, because the money supply does not include any money sitting in the Bank of Canada's vault other than bank reserves. Okay, and number 5, in equilibrium, money demand intersects money supply. So money market equilibrium is where money supply intersects money demand. So connect all these assumptions together. We've got that money demand curve given to us by firms and households. The central bank picks the money supply. They find out where it's located here, and they therefore choose where this intersection happens. They're not just picking M here, they're picking the equilibrium interest rate. According to this liquidity preference model, then, the interest rate adjusts to make sure the market's in equilibrium, that we have a balance between supply and demand. The interest rate's not too high, it's not too low, it's just right. Right? It sounds like Goldilocks and the Three Bears, right? But anyway, if the interest rate is up here, right, at I prime, money supply is bigger than money demand. There's an excess supply. We're not in equilibrium. If the interest rate is down here at I2, that's not squared, but I2, then money demand is bigger than money supply. And we have an excess demand. And so what we're saying is the interest rate will adjust on its own quickly to take us to equilibrium so that we get this balance. Whenever supply is too big, we say, oh, there's too much money around, there's more money in circulation than people want to hold on to. What do they do with it? Right? Well, they try and buy interest-bearing assets. But when they buy interest-bearing assets, it drives the price of those assets up and pushes the interest rate down. Similarly, if we're down here at I2 and money demand is bigger than money supply, there's a bunch of agents going, I want more money than I presently hold on to. I need some more money. I'm trying to buy some money. Can anyone sell me some money? That's a weird sounding statement, isn't it? How do I buy money? Well, I sell something else. I sell a non-monetary asset to convert it to money. So when the interest rate is down here, agents are selling treasury bills and treasury bonds to try and acquire money. If a whole bunch of people are selling treasury bills and treasury bonds, the price of treasury bills, the price of treasury bonds drops, and the interest rate on those bonds rises. And as long as there's this gap, the interest rate keeps rising until we get to balance. Just like over here, as long as there's that gap, the interest rate keeps falling until we get to balance. There's one and only one equilibrium interest rate, given one demand curve, one supply curve. So that's equilibrium in the market for money. And again, if I'm the central bank, I can manipulate where this money supply curve is to determine not just the quantity of money, but the equilibrium interest rate. I can make it bigger or smaller by moving around that curve using my tools. So for example, imagine Jack's the governor of the Bank of Canada. I want to show here how monetary policy influences the interest rate here in the short term. Initially, we're in equilibrium at point A. And suppose I'm over there, the big boss at the central bank. I pick up my cell phone, I call my underling, and I say, hey, I want to increase the money supply from MS0 over to MS1. Right? Please go out and buy a whole bunch of government bonds and pay for it with money that is now being injected into circulation. So we do an open market purchase of bonds. Right? So we're increasing the money supply, we shift the curve. Well, at the initial interest rate, that was the equilibrium interest rate initially, we now have, right, M1 is bigger than M0, right? M1 is bigger than M0. Thanks to that money supply increase, we have that rightward shift. But at that initial interest rate, money supply is bigger than money demand. There's supply, there's demand. We have an excess supply of money. There's more money out there in circulation than people want to hold on to. And the interest rate will fall until we get to equilibrium. Point B is our new equilibrium. And it makes sense that the interest rate is falling. Because when I go out and buy treasury bills, when I buy these treasury bonds and treasury bills, I'm pushing the price of those interest-bearing assets up, which is lowering the interest rate on those assets. Right? I'm pushing the interest rate down. Okay, now let's talk about changing money demand. We'll come back to this later part in a moment. We're going to start by just talking about changing demand. But we're also going to talk about, in a few minutes, something called interest rate targeting. So we're going to consider the impact of a change in money demand and how the Bank of Canada responds to that if they're targeting the interest rate. Little I is the interest rate, T for target. What does it mean to target the interest rate? Well, it means that the Bank of Canada has a desired interest rate that they want to hold. And they say, I want I to be IT. Initially, there's demand, MD0, and supply to get us the target interest rate is MS0, finding our equilibrium right there at point A, and we're right on target. And everything's hunky-dory. I can't believe I just said that, but everything's fine, right? And now suppose a change in money demand happens. That's our first shift here. Suppose the level of output suddenly grows. Yay, real GDP went up. When real GDP goes up, consumption goes up, thanks to the increase in disposable income and the positive marginal propensity to consume. And the fact that we're now consuming more means that money demand went up. The money demand curve shifts over to the right. At any interest rate, including this one, a greater demand for money, a greater demand for money, a greater demand for money. So that's shift number one. At the target interest rate, money demand is over here, money supply is still back there at MS0. The central bank has not done this second shift yet. That comes later. So at the target interest rate, thanks to this shock, this innovation, this shift, money demand is here over here at point C, money supply is still back over here at point A, because supply is still MS0. We have an excess demand for money, and the interest rate has to rise until we get to a balance. So point B is our new equilibrium in the short run. Right now in the short run, the money supply has not changed. So this increase of real GDP causing this increase in money demand has put upward pressure on the nominal rate of interest here in the short run. But the central bank wants to target that interest rate. They don't want the interest rate to rise. The central bank's like, oh my gosh, what's going on here? The interest rate went up. I don't want that. And so the central bank has to put downward pressure on the interest rate to offset this upward pressure. And the downward pressure comes from an increase in the money supply. If that's the desired interest rate, then they say, well, I want to be on the new money demand curve at the target interest rate. I want to be there at point C. I need to increase the money supply. I have to take that money supply curve and shift it over to the right. That's shift number 2. So what would the Bank of Canada have to do to keep the interest rate constant at the target? Raise the money supply by just enough. That's shift number 2. Push it all the way over to MS number 1. At MS number 1, we're now at point C. Money supply, MS1, intersects money demand, MD1, right at the target interest rate. Yay, there was no change in the interest rate. Equilibrium to equilibrium. If we saw this happening and we make shift number 2 right away, we can just stay here at the same interest rate. This is expansionary monetary policy because we've expanded the money supply so as to obtain our target interest rate. So we did an open market purchase of bonds, or perhaps we switched government deposits from the Bank of Canada over to chartered banks, thereby raising the money supply. There you go. I will acknowledge, actually, that in Canada, the Bank of Canada does have a target interest rate. They have a desired interest rate that they want to hold in the overnight market. And so they will manipulate market conditions to try and make sure we stay at target. So in some sense, they're using their monetary policy power, their tools, open market purchase, deposit switching, these sorts of things, to keep the overnight interest rate at target. Okay. So now we're going to talk about the impact of a change in the money supply on the planned expenditure line and the aggregate supply, aggregate demand model. We know that a change in the money supply causes a change in the interest rate. We just saw that in the market for money. So a shift of the money supply curve causes a change in the equilibrium interest rate, and that causes a change in autonomous aggregate expenditure through the fact that the autonomous aggregate expenditure has the planned investment in there, and that depends on the interest rate. It has autonomous consumption in there that might depend upon the interest rate. It has autonomous exports and imports that also might depend on the interest rate. There's a whole bunch of terms in there that either directly or indirectly depend on the interest rate. And so when there's a change of autonomous aggregate expenditure, the planned expenditure line shifts up or shifts down. And that shifts the aggregate demand curve, either to the right or to the left, thereby changing GDP in the short term. So money matters. A change in the money supply causes this cascade of other effects, resulting in a change of GDP, which means then when GDP is changing, a change of employment, a change of unemployment, a change of consumption, et cetera, et cetera, et cetera. So the nominal money supply can influence real GDP in the short run, real employment in the short run, real unemployment, real consumption, et cetera, et cetera, et cetera. So we're going to talk about this process here, and this process is called the monetary transmission mechanism. That one I tried not to make you squeamish earlier. I know I shouldn't have mentioned the virus, but it's sort of like a virus spreading through the economy. Okay, so we're going to go into depth on how a change in monetary policy influences the economy through the monetary transmission mechanism. We're going to talk about those vectors or channels through which a change in money supply will shift aggregate demand, influencing output and the inflation rate. Also employment and the unemployment rate. Because remember, they're directly tied to output in the short run. So, let's talk about Canada's situation. In Canada, the Bank of Canada, our central bank, is in charge of monetary policy, and they conduct monetary policy to target the inflation rate. Okay? So monetary policy in practice here in Canada, we have a central bank that has been ordered by the federal government for the next 5 years, target the rate of inflation. And towards the end of the 5-year contract, they renew. Should we extend the contract? Is this working? Should we have a different target? Should we do something else? And they most recently extended a couple years ago for another 5 years. So in Canada, the Bank of Canada is targeting the rate of inflation. Money is a store of value, is one of its properties. Inflation erodes the store of value feature of money. If inflation gets too high, then money is a less valuable asset. It has a less good store of value. And so we want to keep the store of value feature of money reliable. We want money to be safe. And so we try and keep inflation under control. Inflation is a tax on holding money. So we want to keep the inflation tax small. Okay? So in Canada, the Bank of Canada targets the inflation rate. We have explicit targets. And monetary policy is implemented to make sure we keep meeting that target. The current target is 2%. The Bank of Canada says the optimal rate of inflation is 2%. We would like the inflation rate to be that number. But we're not landing a rocket on Mars or on the moon. There's some room for error. When you're landing a rocket on the moon or on Mars, well, maybe not so much so, because your rocket's likely to slam into the planet or under the moon and get destroyed. And so we would like it to be 2%, but we'll allow it to stay within this range between 1% and 3%. If we get down towards the bottom or the top of the range, then we begin to get worried. Is it leaving the range? And the central bank usually does something to try and push it back towards the middle of the range. So to achieve this target, the Bank of Canada adjusts the target for the overnight rate. They manipulate interest rates so as to try and keep inflation within the desired range and close to the middle of the band. However, if the inflation rate stays within the range, the Bank of Canada can use monetary policy to smooth out business cycles. If you've ever heard the story about the little Dutch kid who puts his finger in the leaking dike to stop the water from leaking out, well, if another leak happens 10 meters away, he can't go over there. He pulls his finger out, and now this one's leaking, and he goes and puts his finger in over there. He can't close two holes very far apart. It's only when they're really close together. I plugged two holes. Monetary policy is kind of like that. If you're busy right now using monetary policy to keep inflation within that range, and then somebody calls up the central bank and says, hey, we have a bit of an emergency in the economy, the unemployment rate's doing something we don't like, can you help us? They're like, nope, too busy keeping the inflation rate in the range, talk to you later, and they hang up the phone. So monetary policy can only do one thing at a time. Kind of like that kid can only, plug one hole at a time, unless they're really close together. But if the inflation rate is really close to the middle of the band, monetary policy is free to go off and do something else. That's what this is saying. The advantages of adopting inflation targeting are sort of two major things: transparency and accountability. Accountability, well, because it's very easy to evaluate. Did the central bank achieve its goal? If we had another goal, like target the quantity of money, well, how do we know whether they met their goal? I don't understand. Which monetary aggregate should we use? M1, M2, M2++? What gives? And how do I know whether you're measuring that accurately or not? So it's very easy to figure out in terms of accountability because it's easy to evaluate the inflation rate. Statistics Canada puts out estimates of that very frequently, and we all understand sort of what that means. It also is transparent. We know what a 2% inflation target means, and we know what will happen when the actual inflation rate deviates from the target one. Oh, the central bank's going to push it back towards target. I hear you. Okay, so again, very transparent, very accountable, and because it's transparent, more people talk about what's the central bank doing. When the actual inflation rate starts fluctuating away from 2% by a lot, People, oh, the central bank's going to have to do something about that. Right? Now we're going to take a look at the impact of a change in the target for that overnight interest rate to the economy. So the Bank of Canada chooses a target overnight rate. We're starting here at point A. This, of course, is real GDP, the nominal price level, short-run aggregate supply, long-run aggregate supply, aggregate demand. So this is the aggregate supply, aggregate demand model. And we're starting at point A. We're in equilibrium at that level of GDP and this price level. And the present level of GDP is below the full employment level. Uh-oh, we're not doing so well. Okay? And so the Bank of Canada says, gosh, the economy is sitting here at point A. Y is below YFE. We have a recessionary gap. In the short run, when we're making less output than YFE, the technology hasn't changed. The amount of physical and human capital hasn't changed. The way we make less output means there's fewer workers being employed. Here at point A, making that much output, there is more unemployment than would be the case if we were in long-run equilibrium at YFE. And so this recessionary gap means there's lots of unemployment right now relative to the long run. And so the Bank of Canada maybe gets called upon. Hey guys, can you help close this recessionary gap? And they say, sure, we're going to lower the overnight interest rate to try and close this gap. They lower that target for the overnight rate. That puts downward pressure on interest rates. That means the cost of borrowing went down, and that means autonomous aggregate expenditure goes up. If it costs less to borrow, this puts upward pressure on autonomous consumption. Autonomous consumption is consumption that is independent of disposable income. And I'll remind you, when you're consuming as a person, as a household, you can consume today, or you can defer off and consume into the future. But when the interest rate is lower, that means today's consumption is relatively cheaper compared to future consumption. You're giving up less future consumption to consume more today. Because if you deferred the consumption today, if you said, oh, forget it, I'm not going to buy as much today, I'm going to put the money in a treasury bill or a bond, and it'll pay me the market interest rate. Well, yeah, now that market interest rate is lower. That means the rate of return on that savings has been reduced. There's less of an incentive to save. And that's why today's consumption rises. Planned investment rises. We all know that planned investment depends negatively on interest rate. A lower interest rate means investment is cheaper to undertake, right? Again, lower cost of borrowing. We invest more. Exports go up. Foreigners say, wow, Canada's exports look relatively cheap, right? In this nice low interest rate environment. Just like Canadians are consuming more, we want to buy more as well. And imports go down, right? These are related to exchange rate effects, which we'll come back to later. That going up, that going up, that going up, this going down, all reinforce and say that autonomous aggregate expenditure goes up. And that means the planned expenditure line shifts upwards and the 80 curve shifts to the right. So that's monetary policy making this shift from AD0 over to AD1. Point B is our new equilibrium. It's our brand new short-run equilibrium. And Y went up. It went up to YFE. And the price level went up. Unemployment dropped. Employment went up. The central bank has removed the recessionary gap because we're now operating at full employment. There you go. Now, I cheated very heavily there. I talked in detail about why that went up. Again, lower cost of borrowing. I cheated when I got to these two. And I mentioned there's an exchange rate effect, which we'll come to in a moment. So when the Bank of Canada changes that target for the overnight interest rate, it will influence the economy in 4 different channels. Right? There's the interest rate effect. The interest rate on other assets and loans will change when they change the overnight rate. There's an asset price effect, a wealth effect. There's an effect through the exchange rate, an exchange rate effect. And finally, there's an effect due to market expectations changing. This is that transmission mechanism. The central bank changes the target for the overnight rate, and it influences interest rates in the economy, asset prices, the exchange rate, and expectations out there in the marketplace. And these all matter for these changes that we saw up here. Okay? Okay, let's take a break. I could use. So now we're going to take a look at the transmission mechanism in greater detail. You'll recall the Bank of Canada has lowered the target for the overnight rate. And again, we're going to take a look at the channels that this mechanism has. I'll quickly say there are a lot of them, and yeah, that's busy. So we'll start one channel at a time. And yes, I'll do this as well. So we censor the page a little bit so we can focus our attention and our discussion. So the Bank of Canada has lowered the target rate in the overnight market, so the overnight interest rate and other interest rates decline because the overnight rate and other interest rates tend to move together. When the overnight interest rate rises or falls, the interest rate on treasury bills does the same. Maybe to a lesser extent, but they move in the same direction. And so the lowering of the overnight interest rate puts downward pressure on other interest rates, so interest rates on other assets and loans declines. And that means the cost of borrowing in general, not just in the overnight market, but in general, the cost of borrowing tends to decline. And that puts upward pressure on planned investment. If I'm a firm or a household and I'm thinking about investing in some new factory equipment, or I'm thinking about renovating my home, I look at the borrowing cost. I look at the interest rate. A lower interest rate means it's easier for me to finance that loan to renovate my home or to buy the capital equipment that I want to put into my factory. And so that reduction in the borrowing cost puts upward pressure on planned investment spending, the spending on brand new capital in factories and at homes. Renovation activity is part of this. And it also puts upward pressure on autonomous, A for autonomous, consumption. Because again, lower cost of borrowing means that I can consume more today. I can get a massive big screen TV to watch the March Madness basketball tournament, or to watch the upcoming NBA playoffs or NHL playoffs. And I can finance that TV. I don't have to pay for it out of my current money holdings, because I might not have sufficient money holdings to pay for that TV. I can get a massive big screen TV, spend thousands of dollars, and I can finance it because the cost of borrowing is cheaper. I'm more likely to buy that TV today or spend even more on that TV. Greater consumption. Everything else the same. Okay? Moving over to the next channel. There's also a wealth effect. Asset prices and the interest rate tend to move inversely. If you ever dabble or look at the stock market, when interest rates in the bond market and in the overnight market tend to be falling, the stock market tends to see upward pressure on prices. And so asset prices like real estate prices and stock prices and interest rates move inversely. And so this reduction of the overnight interest rate makes asset prices rise. So stock market valuations go up, real estate valuations go up, and people feel more wealthy. If Jack feels more wealthy, he's going to consume more. That's a wealth effect. Why not? Why not consume more of my current income? Because I have all this wealth. I have a home that's worth, $300,000, and boy, aren't I rich. Well, okay, maybe that's not what my home's worth, but I sure, it matters to you the value of your overall portfolio. Right? I was reading yesterday that in the state of California, the average homeowner has seen the value of their home rise by 55,000 American dollars so far this year. I was like, what? That's a wealth effect, right? The low interest rates driving up home valuations, making people feel more wealthy. They're going to spend more on consumption. Hey, my house is worth 55,000 American dollars more. If I feel that's a permanent increase in the price, if I feel the price isn't going to go back down, wow, I can buy a new car or whatever because I feel richer. Okay, next channel. The lower overnight interest rate tends to cause financial capital to flow out of the country. Because Canada now has a lower interest rate relative to other countries, and financial capital is attracted to higher interest rates. Since interest rates just dropped here, financial capital has an outflow as domestic assets look less attractive versus foreign assets. And that makes the exchange rate decline. The number of American dollars you can buy per Canadian dollar drops. The number of euros you can buy per Canadian dollar drops. The number of British pound you can buy per Canadian dollar drops. The number of Japanese yen or South Korean won or Chinese yuan that you can buy per Canadian dollar declines. So the domestic currency depreciates in nominal terms. One nominal Canadian dollar now buys fewer nominal foreign currency units. And so that means that exports now look relatively cheaper. Right? Canada's exports look cheap because it's cheaper for foreigners to buy Canadian dollars. When we export a car made in Canada or some lumber or whatever it is we're making, the price of the lumber doesn't have to change in Canadian dollars. When the exchange rate depreciates, a foreign person in the United States or in Mexico or in Japan says, wow, adjusting for the exchange rate in my own local currency units, Canada's exports are cheaper. And so Canada exports more. Imports look more expensive. And that means we import less. Imports are more expensive because, when I try and import some pharmaceuticals made in India, the price of the pharmaceuticals in Indian rupees is whatever it is. But now a Canadian dollar trades for fewer rupees, and that means the Canadian dollar price of that imported pharmaceuticals is more expensive. And so exports go up because of the exchange rate effect. Imports go down, again, for the same exchange rate effect. Net exports, which is exports minus imports, rises. Remember, this enters positively into NX, this enters negatively, so downward with a downward means they both reinforce, and the trade balance goes up. Finally, there's one more effect here, and that's expectation effect. When the money supply rises, because that's what's happening here, when we're lowering the overnight interest rate, we're doing so by increasing the money supply. Remember, the interest rate was something like this, and when we increased the money supply, we pushed it down. So an increase in the interest rate puts downward pressure, an increase in the money supply, an increase in the money supply puts downward pressure on the interest rate. And that's exactly what we're doing here, right? We're lowering the interest rate, which means we're increasing the money supply. And that means people expect more inflation in the future. And so market expectations change. We expect a bigger price level in the future. We expect higher wages in the future. We expect more inflation. E for expected. Expected. So this is the future expected inflation rate, higher than today's. The wage expected in the future, higher than today's. And the price expected in the future, higher than today's price level. So people spend more now before the price rises. Go back to that notion, I want to get a big screen TV to watch sports on it. If I got an inkling that the price of those TVs is going to rise soon, maybe substantially, I might rush online or to the store to buy the TV now before the price increase. And so people spend more now before the price rises, and that puts further upward pressure on consumption spending and investment spending. Right? Oh, I want to put some new shingles on my roof. I want to do that now before the price of shingles rises. And so I undertake the investment spending today, ASAP, rather than wait a few months and find out that the shingles cost a lot more. Right? Same with other forms of renovation. You wait too long and the inflation may have already happened. For example, I remember reading that in 2020 in the United States they had shortages of lumber. There was so much construction activity going on and there was so much trouble moving things across the border between Canada and the United States that lumber was more difficult to get your hands on. And lumber prices, depending upon the market and the type of lumber that you wanted, went up between 20 and 60%. Right? 20%. Whoa. It's a big price increase. Right? You want to buy the stuff now before the price rises. These are the different channels. And let me move all this stuff out of the way now. And let's sneak that a little further north. Aggregate demand is C plus I plus G plus net exports. And the higher investment spending is pushing up aggregate demand. The higher autonomous consumption, making consumption rise, pushing up aggregate demand. The higher consumption from the wealth effect, pushing up aggregate demand. More exports pushing up the trade balance. Less imports, also pushing up the trade balance. More aggregate demand. The expectation effect, more spending on consumption and investment. More aggregate demand. The central bank, by raising the money supply and lowering the interest rate, has stoked aggregate demand. They've taken the aggregate demand curve and shifted it to the right. Right? In the short run, actual output will rise. In the long run, output will not change. Let me repeat that. In the short run, output is wherever the short-run aggregate supply curve intersects the aggregate demand curve. And the central bank just shifted the aggregate demand curve over to the right, pushing up output. And it creates an output gap because the long-run output is at YFE. It comes from total factor of productivity and our production function, physical capital, human capital, labor. In long-run equilibrium, physical capital, human capital, and labor are at their long-run equilibrium levels of employment. And that's fixed. The production function is fixed. Total factor of productivity is fixed because technology is fixed right now in the long run, making YFE some fixed number. So this increase in the money supply that tugged down interest rates stimulated aggregate demand, pushed up Y in the short run, Y in the long run didn't move, and that means that the output gap declined. And we're able to close that output gap. This was a decrease of the target rate. I'll leave it to you to take a look at the opposite, where all this stuff works in the other direction. Where instead of increasing the money supply, you're decreasing it, putting upward pressure on interest rates, and all of these effects are working in the opposite direction, making AD shift not rightwards but leftwards, making actual output fall in the short run, but not in the long term, and thereby making the output gap rise, not fall. Okay? We also need to mention, at least briefly, another sort of technical issue here, and that's the notion of the zero lower bound problem. The interest rate that we're speaking about, little I, is a nominal interest rate. And usually that rate cannot be negative. So it seems the central bank can lower interest rates. That's a form of expansionary monetary policy. Right? Stimulate the economy, close a recessionary gap. But the question becomes, is there a limit to how powerful this policy is? And yes, there is. We can't lower the interest rate forever. At some point, we get a lower bound. So is there a limit for lowering the rate? You betcha. The nominal interest rate is usually not negative. So the fact that the nominal interest rate can't go below zero or very far below zero is called the lower bound problem. This places a limit then on the use of monetary policy. It's like taking a dog for a walk. And you put the dog on a chain. If the dog wants to run, you have the chain to slow the dog down. But if the dog doesn't want to run, and you say run, and you give it more leash, the leash just piles up at your feet. Right? You have an asymmetry here. And the same is true with monetary policy. I can raise interest rates to any bound, but I can't lower them without bound. Right? There's an old saying when you talk about monetary policy that way. You know, when you're doing a decrease in the money supply and you're raising interest rates, it's like pulling on that chain. It's like pulling on a string. But when you're doing the opposite, when you're raising the money supply and lowering rates, it's like pushing on a string. The string might just coil up and not do anything. So there's a limit then on the use of expansionary monetary policy. And this is a challenge that has been faced by central banks in many countries over the last 10 years or so. Right? So to resolve the problem of zero lower bound, central banks like the Federal Reserve, that's the American central bank, and the Bank of England rolled out what's called quantitative easing. In 2007 and 2008, there were terrible financial crises in multiple markets around the world. And in response, there were awful recessions stemming from these financial crises and creating a reduction in GDP, creating a reduction in employment and an increase in unemployment, creating a recessionary gap. And central banks slashed interest rates, increased the money supply to try and stimulate the economy and close that recessionary gap. But they came against the lower bound. They slashed interest rates so much that the target in the overnight market basically became zero. And they said, gee, we're out of ammunition here. What can we do? And so, again, the American Central Bank and the Central Bank of England did what's called quantitative easing. They went out and purchased long-term assets, trying to lower the long-term interest rate. They said, well, the short-term interest rate is essentially zero. Let's lower the long-term rate as well. Maybe that'll help stimulate investment and consumption spending. Right? Trying to exert more expansionary impact on the economy. In 2007, 8, and 9, when these central banks were doing stuff like this, Canada was lucky. We did not use quantitative easing during that recessionary period, known as the Great Recession. But we did resort to quantitative easing in 2020 in response to the pandemic, because the interest rates became so low here. The target rate was almost zero. And they said, we're running out of power. And so the Bank of Canada went out and bought corporate bonds, bought provincial government bonds to try and lower long-term interest rates. They did quantitative easing. Alrighty. Let's take a look at the impact of money on output and prices in both the short term and the long term. And we're going to use our old friend, the aggregate supply, aggregate demand model, to talk about the impact in the short run, the impact in the long run, coming from monetary policy. And what we're going to do is we're going to increase the money supply. So in the picture, we're going to start at point A. At point A, where the initial aggregate demand curve, AD0, intersects the initial short-run aggregate supply curve, SRAS0. So point A is a short-run equilibrium. But it's also a long-run equilibrium because point A is on the long-run aggregate supply curve at YFE. So at point A, we're initially in long-run equilibrium. Yay! And then the central bank says, I'm going to increase the money supply permanently to MS number 1. When we raise the money supply, we're lowering the interest rate, and we know that makes planned expenditure shift upwards, and the AD curve shift to the right. Point B is our brand new short-run equilibrium, where the present short-run aggregate supply curve intersects the present aggregate demand curve. That's the brand new one here, AD1. At point B, Y has gone up. Since Y went up, employment has gone up. The only way to make more output today is to hire more workers. So we have more employment, less unemployment. And yes, the price level went up also from A to B. So there is some increase in prices coming from the higher money supply. So there we go. The economy's booming. More employment, less unemployment than usual. Now let's take a look at the longer term impacts. At point B, we have an inflationary gap. The words are not just random. That means we're going to see inflation in the longer term. So in the longer term, since Y over here, Y1 is bigger than YFE, there's pressure for wages to go up. Workers say, oh my gosh, you're working me really hard. I'm overworked and underpaid. When my contract expires, I'm going to negotiate for a higher pay. And so in the longer term, there's pressure for wages to go up. When wages do go up in the longer term, the per unit production costs rise. And the per unit profitability falls. And that takes the short run aggregate supply curve and it shifts it over to the left. So the short run aggregate supply curve shifts up and over to the left. And it keeps shifting to the left, and wages keep rising until we get back to YFE. Once the short run aggregate supply curve is shifted along the current AD curve all the way back to YFE, we've made it to long run equilibrium at point C. So point C is our brand new long run equilibrium. Y has dropped back to YFE. P has gone up even further. Employment and unemployment have gone back to their long run levels. So in the short run, this increase of the nominal money supply not only influenced the nominal interest rate, but it changed real GDP. It changed real employment, real unemployment, real consumption, real investment. But here in the long term, why didn't change long run to long run? Consumption didn't change long run to long run. Employment and unemployment didn't change long run to long run. The only thing that changed in the long run are nominal variables. We changed the nominal money supply permanently. We changed the nominal interest rate. We changed the rate of inflation. We changed the nominal wage. And we changed the nominal price level. But employment, unemployment, GDP, consumption, they're all back to their usual long run levels. In the long run, monetary policy did not influence anything real. That's an acknowledgement of something called monetary neutrality. So what we just saw was the money supply will not have any influence on a real variable like real GDP in the long run. We have long run neutrality of money. Neutrality is kind of like when you talk about politics. You know, we're going to have a war in Europe. Who's on my side? Who's on the other guy's side? And Switzerland says, I'm on nobody's side. I'm neutral. I don't influence the outcome of the war. Right? And so we're saying money is neutral for real variables in the long run. But in the short run, it influences real things. So again, money is neutral in the long run for real output because real output comes from inputs and technology. And as long as inputs and technology stay the same, output in the long run stays the same, no matter how big or small the money supply is. When aggregate prices go up, both output prices and input prices rise by basically the same proportion. There's no change in the real values of the goods and services. There's no change in the aggregate demand, equilibrium to equilibrium. At point A and at point C, in equilibrium, we have the same level of aggregate demand in terms of real GDP. All we have is more money chasing after the same amount of output. Oh, well, if there's more money chasing after the same amount of output, that means we have higher nominal prices. We have only nominal variables are being impacted here in the long run. So let's remind ourselves of how the aggregate supply, aggregate demand model comes from the income expenditure model and how interest rates directly and indirectly enter these models. So the income expenditure model, in generic terms, with numerical values. We have an aggregate consumption function. We've got taxes, perhaps levied as a percentage of income, but also perhaps some autonomous level. Transfers. That's the transfer clawback. There's our autonomous transfers. Planned investment. There's a direct influence of the interest rate. Government spending on goods and services exogenous. Exports and imports exogenous. Right? We plug in perhaps values for each of these exogenous terms and interest rate sensitivities and stuff like that. Transfer clawback, tax rate, margin penalty consume. Okay? The planned expenditure line is C plus I, planned, plus G, plus exports minus imports, the trade balance. And we get our planned expenditure line. Income, expenditure. Along the 45-degree line, income equals expenditure. So where the planned expenditure line crosses the 45-degree line, we have the short run equilibrium level of output in the income expenditure model. In this model, a change in the nominal interest rate only influences planned investment directly. Okay, you don't see any little I elsewhere, right? So that's talking about that direct effect. Well, the interest rate's held frozen at a particular level, maybe 2%. So 0.02 meaning 2%. We find the initial equilibrium. First, we find disposable income is Y minus T plus transfers. We get that as an expression. We plug that into our consumption function to now get consumption as a function of Y. And now we get our planned expenditure line, C plus planned I, where we plugged in the interest rate that's given, plus G, plus exports, minus imports, and we add it all up and get this. And equilibrium, where Y equals planned aggregate expenditure, where Y equals planned aggregate expenditure. So set this expression equal to Y and solve for the equilibrium Y. Okay? And that's how we get this Y star. Of $4,850. Okay, so that's our beginning. Now suppose the central bank comes along and alters the interest rate by changing the money supply. Right? So they lower the target for the overnight rate by 0.8 percentage points. Again, expansionary monetary policy. So our new interest rate, it used to be 2%, but now it's dropped by 0.8 percentage points. You got to remember how many zeros to use. So our new interest rate is 1.2%. So of course, as usual, there's two ways we can go about this. We can take the long route, or we can take the short route. Of course, we'll show the long one first. We want to find the new planned expenditure function, and then solve for, it shifts up, solve for the new Y. Well, when the interest rate drops, that puts upward pressure on planned investment. And we know that we got this interest rate sensitivity. We got the change in the interest rate. We plug in the interest rate sensitivity was 5,000. We put in the change, multiply that out. Planned investment spending rises by 40 units. And that means autonomous aggregate expenditure rises by 40. It used to be AE0, now it's AE0 plus 40. The whole line shifted up by 40 at every Y. Oh, okay, gotcha. So our planned expenditure line is now got the 1940 it used to have plus another 40. So 1980 plus 60% of Y. And we find equilibrium where income equals expenditure. So that means that Y equals 1980 plus 60% of Y. Bring this 60% of Y over here, it now becomes 40% of Y equals 1980. Dividing both sides by 40%, Y in equilibrium, or in our new equilibrium, will be 1980 divided by 40%. And that gives us, using our calculator, almost 5,000, 4,950. Y went up by 100 units. We used to have 4,850, now we've got 4,950. So our initial Y was 100 less than what we're getting now. Alternatively, we can take the short route. Use the multiplier. to find a new y. The change in y in equilibrium is the change in autonomous aggregate expenditure times the multiplier. The change in autonomous aggregate expenditure we already isolated was 40, and the multiplier is 1 over 0.4, which of course is 2.5. 2.5 times 40 is 100. Y went up by 100. So the new y is the old one, 4850, plus 100, 4950. Hooray. Here's a different numerical example. Warning. Here's a different numerical example. These are different numbers. These are different numbers than were used on the last couple of pages. We're looking at the aggregate supply, aggregate demand model. Here's our planned aggregate expenditure line. Here's our short-run aggregate supply curve, price level, real GDP, nominal wage. And here's our long-run aggregate supply curve. In long-run equilibrium, YFE, Y is equal to 800. Initially, the interest rate is held fixed at 2%. And so we find our initial long-run equilibrium, find aggregate demand, right, by taking our planned aggregate expenditure and setting Y equal to planned expenditure and rearranging and solving to get this aggregate demand curve. Alternatively, that aggregate demand curve. They are the same curve. He pauses for a moment. Take your planned expenditure line and set Y equal to this, so Y equal to this, and rearrange and solve. Okay? And that's how we get aggregate demand. The long run equilibrium level of output, well, there it is right there. What's the long run price level? Oh, well, you plug this output into here. 25% of 800 is 200. 300 take away 200. Price level's 100. And yes, you could take this number and plug it in here. It's the same math. And the equilibrium nominal wage. In a long-run equilibrium, the short-run aggregate supply curve has to intersect the aggregate demand curve at YFE. Oh, okay. We know the price level is 100 along this aggregate demand curve at YFE. So we can take that price equal to 100 right there. And we know that Y is equal to 800. We can plug that right here. And, of course, this is 10% of 100. Or sorry, 10% of 800. 10% of 800 is 80. 80 plus 20 is 100. This 100 cancels with that 100. And I got W equals P. Oh, W equals 100. So there's our initial long-run equilibrium. This is going to be point A in our diagram. Real GDP, nominal price level, long-run aggregate supply, 800, right there at YFE. Aggregate demand when the interest rate is 2%. Short-run aggregate supply when the wage is 100. And point A is our initial long-run equilibrium. Y is 800. P is 100. The wage is 100. Yay, we're in long-run equilibrium. And now we're going to have some shifts. Now suppose the central bank lowers the target for the overnight interest rate by 0.8 percentage points. Again, expansionary monetary policy. The money supply is going up here. And we're told that this is such that autonomous expenditure increases by 70. So our new aggregate expenditure function is our old one with another 70 here in the intercept, which means our new aggregate demand curve is here or here. The aggregate demand curve is shifted to the right. Point B is our new short-run equilibrium. GDP did expand. Not only did the money supply expand here, so did economic activity. There's higher levels of GDP, which means there's higher consumption thanks to the positive marginal propensity to consume. There's more employment, less unemployment. The central bank has expanded economic activity. Okay? And so we can find our new short-run equilibrium levels by finding where the AD curve intersects the short run aggregate supply curve. In the short run, the wage stays frozen at 100. Wages are sticky in the short run. They don't change yet. Point B is on the initial short run aggregate supply curve. And so we go to where the short run aggregate supply curve intersects the new AD curve. And you'll notice we plugged in that wage of 100. And now this is one equation involving only one unknown, y. 35% of y equals 350. Y in equilibrium then is 350 divided by 35%, or 1,000. We plug that y of 1,000 into the AD curve. We've got price equals 370, take away 25% of y. Oh, 25% of 1,000, though, is 250. 370, take away 250, leaves behind a price level of 120. So the price started at 100, but it's moved up to 120 as we moved up along the upward sloping short run aggregate supply curve, thanks to this increase in aggregate demand coming from the increase in the money supply. In the long run, we have the same story we had earlier, qualitatively. Right now at point B, the economy is booming. There's more output than usual. There's more employment than usual, less unemployment than usual. And point B sees an inflationary gap. Y is bigger than YFE. And workers say, my goodness, am I ever overworked and underpaid? And it's like the people here at the university that are still working on the campus saying, my goodness, they're asking me to do way more than they used to ask me to do, and they're bothering me on weekends and nights and stuff like that, and they won't leave us alone, and all this for the same pay. What gives? Right? And so in the longer term, people ask for a pay increase. And that's going to shift the short run aggregate supply curve up towards the left. Point C will be our new long run equilibrium. We'll be back at YFE, but the wage has gone up, and the price level has gone up even more. Of course, we can do the maths here. So in our new long run, we're back at 800. Right? We're back at YFE. We're back on that line. We sub that YFE into the AD curve to find out what P has to be then. You go, oh, okay, I got you. We take our new aggregate demand curve, plug in the 800, and oh, the price level's got to be 170. And that's how you get that new price level, 170. You take that new price level, right? You plug the YFE of 800 and the new price level into the short run aggregate supply curve to find the new wage. I've got 20 plus 10% of 80, or sorry, 10% of 800, which is 80. That's 100. That cancels with that. W equals P. Oh, W is equal to 170, because again, it equals P. So in the long run, we've got the same Y that we had in the initial long run. We've got the same consumption we had in the initial long run, the same employment and unemployment we had in the initial long run. We even have the same real wage. W divided by P is the real wage. Call that the real wage, he says right off the screen. So W is the nominal wage. W divided by P is the real wage. In the long run, not a single real variable's changed. Same real Y, same real consumption, same real employment, same real unemployment, same real wage, same real investment, same real everything. All that changed was the nominal wage, the nominal price level, the nominal money supply, the nominal interest rate. Only nominal variables changed. That's that neutrality. Okay? Stay safe, everyone, and take care.